First things first, though, some housekeeping things. Number one, some of you sent me your homework like literally last night. Okay, the deadline was Thursday at 6 p.m. So if you sent me anything past that due point, I'm not going to grade your homework. Okay? Or the quiz that we took. And I know that that sounds kind of harsh, but the truth is, like, you guys have to understand that I'm taking 3 classes. Not only do I, teach you all, then I have like my daily responsibilities, which are my watch list, and then I have like my research projects. So you need to understand that when I give you a deadline, it's for 2 purposes. One, to see if you're paying attention, and the second thing is like Matt's got shit to do. Okay, I don't have time to mess around with people who can't read an email. All right, you think your life is complicated? In comparison, no offense, you have time to do stuff. Okay, and the other part is like quizzes let me know who's actually like wanting to actually like learn versus people who are just like sitting in here expecting some kind of osmosis effect, meaning if I just sit here I will learn stuff. Okay, get your shit together, guys and gals. All right, don't do that. So if I give you a deadline, I expect it to be within that deadline. If it's not in that deadline, then I'm not going to touch it. Okay, just understand that. All right. Are we all clear on that? Give me a yes in the chat box. Good. All right. So just understand that about me. Okay? You know, you like people like try to give me some kind of excuse of like why, and it's like it's only a 32 question quiz. Like it's not even like a huge deal. And people try to make it out you have 24 hours in a day. Okay? I sleep for 4 to 6 of those. The rest of the time I'm working. Even if I had a full-time job, it wouldn't even matter. Okay? So I have no sympathy. All right? Don't tell me an excuse. Just say, hey, I'm too lazy and I don't want to do this, so don't even try. All right? Period. All right. Next thing is, do we have any questions on the stuff that we've gone over so far? If you do, please type that into the chat box so that I may answer those. Anything to do with options, penny stocks, futures, stocks? Is there anything that's unclear? Okay. So if there is, please be typing it in, but I'm just going to go on a small rant. So a couple of things that I noticed with you guys, okay? So some of you on, let's say, the last section of the quiz, which was like question number 32, which was like, why do stocks move up and down? Some of you decided to take the liberty of telling me about people's emotions and that's why stock prices move up and down and blah, 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 blah. That's absolutely wrong. Okay. People's emotions in terms of price movement are generally short lived. Okay. And eventually supply and demand will take over. Okay. The other thing is like in our class, in terms of penny stocks, a lot of you like put that penny stocks were, would you put like, sub pennies? It's like, yeah, but in this class, it's anything that's under $5, and it can be on, it doesn't have to be in the OTCBB or the exchange or the pink sheets. Okay, it can be on NASDAQ. Okay, I don't trade penny stocks in the OTCB market, but you should understand that when certain listing requirements for the New York Stock Exchange or the NASDAQ or the CME or any of these things, like, well, not really the CME, but those two exchanges, when stocks don't meet that requirement, then they go to the OTCBB or they go to the pink sheet market. Okay. So a lot of you, I don't know if you didn't understand that there's like a delineation. And yes, I'm going to increase your guys' vocab words, okay? Meaning delineation, meaning two separate like splits, like a split in something into two categories. Think of it like a line in the sand. All right. So in each category, like you can have you'll have a split between, you'll have OTCBB. You can have stocks that are trading under $5. Remember, one of the requirements by the New York Stock Exchange is you have to have your stock price above $1. Okay. So remember that. All right. And I don't trade like sub pennies, and I don't trade things that are generally OTCBB. They don't, just because it's under, $5, it's not, it can be on a normal exchange. Okay. I want to make sure we're perfectly clear on that. Some of you had also like some real trouble, honestly, with the option stuff, and you need to go back and watch that. Some of you, I could tell, blatantly just copied what was like word for word from the slides, and that's fine. But you need to, in any kind of future quiz, write things in your own terms. Okay. And the reason I say that is because I want to see if you understand it, not that I understand it. And I will say this, from the people from around the world that I have in this class, okay? The people that were not in the United States did a much better job of writing it in their own terms than people from the United States. Okay? Now, why is that? The reason is there's a vast difference in how studies go overseas versus how it's done in the United States. And a lot of tests overseas are not multiple choice. They're generally, like in Germany, we have a thing called the Abitur, where if you want to get into college, you have to take it's an insanely long exam, and they grill you not only like in questionnaire form, but also like in front of a panel of people. Okay. It's intense. So you have to know the information inside and out, because you have to regurgitate it in your own manner. And in the US, I find that when teachers give like study guides and stuff, people, directly copy the information. That doesn't mean you know the information. Okay. So in the future, I would rather see your interpretation to the question in your own words of what that means. Does that make sense to everyone? Because if you can't demonstrate that, then you don't understand. All right? Because there's different levels of understanding. So the quicker you can translate something into your own words. So even if you go back and you watch the video and you're like, okay, I understand that, regurgitate that if I give you a quiz in your own words, because if you're able to do that, you will retain the information. Okay? You're not going to remember textbook definition. Period. It's just not going to happen. But if you can understand it and regurgitate it in your own words, you will be far better off on, comprehending that information. Okay? And I'm telling you guys this is because it's a learning technique. It really is. So, you know, the ability to do that and take complex ideas and be able to give them to someone else, it comes down to being able to understand the information both back and forth. All right. So, outside of that, in terms of options, it really just comes down to, when I say advantage and disadvantages, you guys need to understand what I'm asking, which is the advantage of buying a call option or just buying options in general is you have unlimited upside potential and your risk is finite. The disadvantage is you're against time and you have that theta decay. You also get volatility in your favor a little bit if you're long options. And now volatility can also work if you're short options, but sometimes it won't make sense, especially in like huge market crises. So the thing is like that's the advantage and disadvantage. Very simple. The second thing is for selling short options, you have the disadvantage is you have unlimited risk and a very small like profit potential, right? But the advantage is like if the stock or the option, or I should say in the stock, if it goes in your favor or it just does nothing, you'll win because 65% of the time, basically, options expire worthless. And that is a huge advantage because it's an edge in the market. All right. So people who are generally buying puts or calls have a disadvantage inherently because they have to be right, like really right. And the people that are selling these things don't have to worry about that. They basically benefit from the fact of the market's going to go sideways or in their favor, and there's a small probability that it actually goes in the favor of the other person. So that's why people choose to do it. But it's not like some of you wrote like some kind of weird ultimate edge hypothesis, and I was like, what the hell are you talking about? Because it's not an ultimate edge. It's just by definition, if you are capturing 2/3 of what something can do, you have like a small edge. All right. But how you proliferate that edge is very key because you could lose all of your money and then some. Okay. So it's not like this magnificent edge. It's just an edge that exists naturally. Okay. And there's a big difference between mining an edge and an edge that just happens just because that's the way the game is set up. Okay. So just understand that it's not like this huge, mystical, magnificent edge. It's just an edge that naturally occurs because of the game. All right. So those are kind of my three main things that I took away from your guys' quiz, which helped me learn a lot of like who's, where, I guess. So that was good. So today we're going to be talking about basic terminology. We're going to take a step back. All right. Some of you may find this boring. All right. Some of you may find this like really rudimentary. But basically, we're just going to go over the structure of everything and some key terminologies that I think that you all need. And then we're probably, I don't know where we'll stop it. So I don't like to, people have like an attention span of like an hour and a half. So we'll try to fit everything inside of that time frame. So today, like I said, it's gonna seem like we're gonna take a step back, but it's just to make sure everyone's on the same page. Okay? So What is going long? All right. And I know this may sound basic to some of you, but this is like the first thing that anyone ever learns. And remember, you guys can like type questions into the chat box to stop me. So it's basically just expecting a stock, a commodity, or um, whatever you bought will basically rise in price. And I've just got to get my little pen tool here. Put you over here. Okay. So, and then, so buying a stock or futures contract with the expectation will rise in price. The goal is to sell at a higher price than what you bought it at. And you lose money if the price falls and you have to sell at a lower price. So this is the most common thing that everyone, I don't know, I think even like a 10-year-old would understand like this concept just because it's the most common thing that's taught to people. So I gave a little example here. This is from one of my algo systems. So I bought here and it sold there. And because it went and because it was long, we made money. And the blue line means it was in profit. If it was red, it would mean that it lost money. But so it's just the expectation of something rising in price. And the best way to think about going long or going short is just to think of it in terms of betting. So if you go long, you're betting something will go up. If you're going short, you're betting something's going to go down. Okay, so being short anything is expecting the commodity or the stock is going to go down in price. So I think one thing that people don't understand is like people try to get caught up in the minutia of trying to understand how someone can go short a stock. Okay, in the futures market, because there's always buyers and sellers, selling short is like a common practice. All right. So going short is the expectation something will fall in price. Okay. And the goal is really to then buy it back. So at a lower price. So generally speaking, this signal went short here and it covered here. Okay. And this signal went short here and it covered here. Okay. So when you sell short something, all right, you're expecting price to go down from wherever you sold short from, and then you're going to buy to cover at hopefully a lower price. Now, if the stock goes up against you, you'll lose money. All right. And you can try to like understand all of this in terms of the stock world, but that's all bullshit in my opinion. I just give it so you guys can know like how it's done. But really, you just need to understand that if you sell short something, you're just anticipating price will go down, and wherever you sell short, that's your entry price. And if it goes up, you would start to lose money. All right, and the same thing goes in commodities markets. All right, because selling short is actually providing liquidity to a buyer. All right, you're basically the intermediary. All right, and another thing, something that's actually not taught anymore is people are like, why is it called a bull market or a bear market? And it's called, bulls because a bull thrusts their horns up. And usually a bullish market is a market that's generally trending up. And then another thing that people don't seem to know anymore is like, why is it called like a bear market or why is it bearish? And it's because bears swat their paws down. Okay, that's that's how they came up with it, I guess. So it's just one of those little fascinating pieces of history that gets washed away and is never taught. People, especially in mainstream finance, get told this is a bull market, this is a bear market, and people are like, why do we call them that? Okay, but it's just the terminology to describe something is either trending up or down, and that's how they came up with the terminology. All right, let's get into entry orders. So entry orders are now every broker or platform may be slightly different, but entry orders, there's generally a gambit of them. Okay, And I want you guys to focus of how I organize this information, which is literally these things are what um, you're going to generally focus in on. All right. And the cool part about trading terminology is generally it's pretty specific. So if a market's going up, that's a bull market. If a market's going down, it's trending downwards. How people define trend, that's where the water gets kind of murky. But generally speaking, if someone sees, oh, it was high here and low here, they'll be like, oh, it's in a bear market, or vice versa. And um, so there's that category. And then with entry orders, we do the same thing. And I think the entry orders are actually pretty clear in terms of a lot of terminology that's out there for most uh, finance terminology. So if we buy something, remember we're going to bet, we're going long. Okay. So if you see an order that says buy and you click buy, you're going to buy it at X price. And then if you're going to get out of it, you're going to click sell. All right. If you want to short something, meaning you're going to bet it's going to go down, then what you want to do is you're going to sell short. Okay. And to get out of that position, you're going to do what's called buy to cover. And that may seem kind of like no duh to a lot of you, but I swear to God, I will get people that are like, I'm going to sell this stock at X price. Okay. And what they're saying is they want to go short. Do not do that. Okay. Always be clear in what your expectations are. All right. I've been around long enough and trained enough people for them to mix up these two things, and it's a big no-no. Okay? All right. Now, that's how you would get into a stock and get out of a stock, or a futures contract or not a futures contract. So if you want to get long, you would buy, sell. It's the same process. There are other kinds of orders that you need to be aware of. So there's a limit order. A limit order will buy a set asset at a very specific price. So if the market is coming down, and you'll hear I reference the market's going down a lot just because I'm generally short biased. It's my personality. I'm an asshole. But overall, like if I put a limit order here to say buy X contracts at we'll just say $50, okay, or shares. What's gonna happen is like if it comes down here, and it moves through, if the price moves through, I'll get filled. Okay. If the price touches this though, so let's say I see that it's sitting at price is sitting at 50, and some people are like, why am I not getting filled at $50? Because price needs to move below in order to get filled. Okay, does that make sense to everyone? So if you set a limit order at 50, you'll be filled at 50, but if price comes down and it's just sitting at 50, it's not going to be accepted until the ask comes below 50. All right. And then it will get filled. Okay. Some people don't understand that, but that's how the market actually fills orders. So price has to move through in order to be filled. So if you set a limit order, you're just saying this is exactly where I want to be bought at or sold at. All right. A market order is something that if you wanted to get into the market right now at whatever the price is, if you want to sell it short, if you want to buy it, so if you want to bet against it or you want to bet that it's going up, you would get filled at whatever price. Now, this can be dangerous, okay? In a high volatility situation, people who trade discretionarily, meaning they trade from their gut, will try to use a market order to hop on board a price movement. Now the problem with doing that is because games get played, they could get filled at way higher. Or if there's a bad tick that comes through, They can get filled way up there. Okay. So market orders are dangerous. So, in my opinion, if you're ever going to buy or sell short something, try to use a limit order. Okay. Unless you're like completely mechanical. And that's like a totally different conversation. And we will get there way down the road. But the thing is like, try to avoid to using this just because you can get smacked. But people usually use this. If I had a lab of people would usually use market orders because they're panicking. They want to get in. They want to get in right now. And it's like, calm the fuck down. Okay. If you are methodical in what you're going to do, you're always going to generally use a limit order. Okay. A stop order, all right, is also referred to as a stop loss order, is an order to buy and sell a stock once the price of stock reaches a specified price. So let's say, going within our example, we're filled at like $50. Okay. We could set a stop loss order at like, let's say 49. So meaning if we're long here and then it moves down here, we would get stopped out. All right. So we would take a $1 loss. We could also set some stop orders up here as targets. So what we could do is we could also say, we're going to set this at 51. Okay. And so if the price moves up there, we could get stopped out up here. Usually though, when people talk about stop orders, they're talking about stop loss. But as you become more familiar with the market, you'll understand that you can also use stop orders as price, targets basically. Okay. Stop market order will execute as a market order once the stock reaches a specific price. So this is an interesting one, because a stop market order can sit. So remember in this example where we were sitting it at 49. Okay, so this would technically be a stop limit order and a stop limit order up here. Okay, we could also do what's called a stop market order, which means that if price comes like sneezes around this like 49 area, we'll just get stopped out. Okay, now what's the danger of doing that? Danger of doing that is really the fact of, you can be filled at any price, and oftentimes it won't be too crazy, but it could. But the advantage of doing that is like, if the market's moving fast and it gets close to that, like, you're just going to get stopped out somewhere within that range. Okay. But generally speaking, we use limit orders all the time. Okay. So either it's a stop limit for a target or a stop loss, or it's a limit order to get in the market. All right. Is there any questions on that? It's pretty simple, I think. All right. A trailing stop order. All right. So a trailing stop order is something that people believe is a good thing to do. And essentially what it is if let's say I'm long at 50 again. Okay. Market's moving up. I can put a trailing stop. So if I'm long, I want the market to go up, and I can put a trailing stop underneath of this $50. So I'm in, and then it puts a trailing stop right there. So as the market moves in my favor, the stop loss adapts and moves with it essentially. And then let's say it like pulls back, then I'll get, my trailing stop maybe hit. Okay. So when you do that, that's like an adaptive stop loss. A trailing stop loss is an adaptive stop loss. It's always going to move with the direction of if you're right. If you're not right, it's just going to chill where it once was. So I like to view it as, okay, I'm long. So if I'm long here at X, I'm expecting price to go up. All right. And my trailing stop is just going to sit here sideways. If the market starts to move like this, my trailing stop is going to move with it. And then if If the market starts to just go sideways, my stop loss is also going to go sideways generally, and then it's just going to chill. Okay, and it may get hit or it may not. The idea behind them is basically it's going to follow the market, and it's going to hopefully, keep you in profit, and you'll get stopped out in some kind of profit. But if you buy here and the market goes immediately against you, and it moves into your trailing stop, you're just going to get stopped out for a loss. Okay. Alrighty. Next thing is day orders. So if you are a stock trader or a futures trader, you need to understand that between 9:30 a.m. to 4 p.m. is the general regular market hours. That's what's considered the market hours. And you need to understand that when, especially in stocks, if you're buying during the day, let's say you set an order up, it's generally going to be automatically put as a day order. So at 4 p.m., when the market closes, and let's say you put a limit order in to like buy at X price, it's going to be automatically canceled. Okay? Remember that. A lot of people are like, oh, I put an order in it, but it disappeared. It's because it was a day order. If you want to just have that order sitting on the market, then you need to use what's known as GTC orders. Okay, you can do day plus extended hours. I think a lot of people, all different kinds of brokers have all different kinds of weird stuff. You can read up on day plus extended hours, AM and PM or whatnot. But really, if you don't care and you just want to be filled at X price, then it's just better to use a GTC order, because it's going to be good until you cancel it. Now, what is the danger of this? Well, sometimes people forget that they have GTC orders sitting on the market. So they may do their trading thing for weeks or months, sometimes even years, okay? And they may forget that that's sitting there in their order like queue, and they could get filled, and they're like, what the hell? Why did I get filled on this order? Is this because you put a good till cancel order? So I would only I would use this most often than anything else if I'm expecting if I want to, like, let's say I see prices going up and I want to buy a retracement, so meaning like price moves back down, so I could put a good till canceled order there if that's what I want, and I could put a good till cancel like stop order up here as a target, all right, or a stop order down here as a stop loss. Okay, so you could read up on day plus extended time, but really the things you need to be made aware of are stop orders, trailing stop. You need to be aware of limit orders, market orders, and then stop limit orders and good till cancel orders. Those are kind of the main things. And remember that the general stock market is open from 9:30 until 4 p.m. The futures market is in what's known as Globex, so meaning it's open 24 hours. Generally, it closes for 1 hour, so technically it's 23 hours. And then that's pretty much it for that. Okay, are there any questions on that? Really, any market you trade, though, make sure you do your research on like how and when it's open. Okay, that's the best advice I can give you. A lot of people don't do that, and it's like, well, seriously, you have to if you're gonna do something, know about it, right? Don't assume that the market hours are the same for everything. They're not. Okay, so as you guys probably are aware of, when we talked about futures and we saw that little printout sheet, right, of like what each point value was. And let me say this, you guys nailed the point value stuff, so that's good. On the quiz, I was really nervous about that, honestly. But overall, you need to know like the market you're trading, how much something is worth, and you need to know, and it's a publicly available information of when that exchange or contract or stock is trading. Okay, But most people only understand the stock market, and therefore they only think that the market's open from 9 a.m. until 4 p.m. And that's when the most quote unquote liquidity is, because that's where most people think all the trading is. But for futures traders, the market is generally open all the time. Okay. Next thing I want to do is kind of just go over different bar types. So this is what's known as an open, high, low, close bar. All right. So very simple. Price is trading. The high is always going to be a the high is always going to be, let me get my little pencil. The high is always going to be up here. The low is always going to be down here. This is generally where it opens, and this is generally where it closes. And the structure will always be the same, meaning if you have the bar right here, you're going to have the close here and the open here. Okay? So open is always on the left-hand side. Close is always on the right hand side, and the top of the bar is the high, and the low of the bar is the low. All right, and these are the old school bars. Okay, so back in the 80s and the 70s, this is generally all people ever did. Okay, or used. All right, because it was just simple to like draw that and write it out. So these are what's known as OHLC. And these OHLC bars are based on the close. Okay, there's other variations of this, but that's just the basic structure. Okay, so OHLC bars are also time based, and you need to understand like the difference between, in the way I view it at least, the difference between the close and the open is a unique relationship. All right, so if a bar is to considered up, all right, an up day is always, from an OHLC or any bar perspective, is always going to be the close. Okay, so close, we're going to put C, is greater than the open. For a down day, okay, a close is always going to be less than the open. All right, which is why we have this like green and blue stuff. All right, another kind of way to look at a chart with different kinds of, I would say, data, is another kind of data that a lot of people use is, or I should say transformation of price, is candlesticks. All right, so I want to be clear about something right off the bat, and you guys probably know, like, I use a thing called Ichimoku Cloud. So candlesticks and the Ichimoku Cloud were supposed to be things that work together. They were never supposed to be divided. But of course, some asshole person from the US went over to Japan and only took what he liked and only brought back what he liked. And so for a long time in the US, people only used, candlesticks were this newfangled thing. So the Japanese began using technical analysis to trade rice in the 17th century. While this early version of technical analysis was different from the US version initiated by Charles Dow around the 1900s, many of the guiding principles were very similar, and these candlesticks. So the what is price action is more important than the why, news, earning, and so on. All known information is reflected in price. Buyers and sellers move markets based on expectations and emotions, fear or greed. Markets fluctuate. The actual price may not reflect the underlying value. So in order to create a candlestick chart, you must have data set contained to open, high, low, close values for each time period you want to display. So much like the candlestick charts are also more appealing to the eye, which is why a lot of people use them. But same kind of thing as the open, high, low, close charts, which is so this, when you see a candlestick, this is the wick. These are known as wicks. And the same thing. So this is the high and this is the low. And the nice thing about candlesticks is if the close is greater than the open, then the bar will be green. If the If the candlestick is red, it means that the close was less than the open. And so the body of the candle, so wherever this was in a green candle, that was the close. Wherever this is the open. Okay? And vice versa. All right? Same thing though. Open, high, low, close. Candlestick, is formed. And like I said, people generally like use these a lot more. Okay? It's more appealing to the eye. But it's the same information, just served up a little bit differently. So you need to understand that OHLC, candlestick charts, all of these things are based on what's known as time. Okay? And what does that mean? All right. Well, if you're looking at a 5-minute chart, so in this example, I'm using oil. So if you're using a 5-minute chart, all of these bars are printed every 5 minutes. Okay? What's the problem with that? The problem is it's only printing a bar, and whatever activity over the last 5 minutes has happened in that bar. That means that if a bar is printed every 5 minutes, if there's no activity in that bar, it's still going to print a bar. Do you see how that could be a problem? Because that would be considered false data, in my opinion. And the reason that's considered false data is because 5-minute charts don't tell you what's actually happening in the bar. They're just showing you a glimpse of what's happening every 5 minutes. And if there's nothing that's happening, it's just going to print regardless of anything. All right. And that is the flaw of time-based charts. So you always get all these little day traders, these little bullshitters that are like really into like 1 minute and 5-minute charts, and it's completely useless information, not only because it's a small time frame, but because like minute charts, they're any type of time-based chart, its inherent risk is it's not telling you actual information of the market. Okay? And you see how noisy this is. You see how it's like all over the place. Okay? There's no, it's not smooth. It's really jagged. Okay? And that's because probably there's some false data that's just being fluffed in because it's just doing what it was asked to do. It's just like, hey, print a bar every 5 minutes. Like, okay. So the other thing is then what I like to use, if I can, is tick charts. Okay? Tick charts are not based on time, but on actual trades or volume. They, in my opinion, are the best. They also help filter out noise when it comes to seeing trend. It also gives rise to new bar types that nobody ever uses or looks at. Remember, if the herd is all looking one way, we want to put on a different lens to see nuances. Okay? So what I did is I tried to pair up this chart, which may be hard for you guys to see, but in the recording it will be crystal clear. But the thing is that what you're seeing is this is the same kind of price action. Okay? Let's see. Let me make sure I'm lining this up correctly. Never mind, because I couldn't line it up too correctly. So here's the 25th and the 26th. And here is the 25th and the 26th. Okay? Same area. So you see, first of all, it's not elongated like this. It's pretty short. All right? The second thing is it's not as choppy and wide. Okay? So it pretty much accomplishes the same thing, just a lot smoother. All right? You can see an uptrend is happening. Whereas this, in my opinion, it's like, okay, it's pretty rigid. All right? And also, when we look at the downside of this, you can see how like rigid and choppy. Look how smooth this is. Okay? So, and the nice part about tick charts is like, we know that each bar that we see is an actual trade. All right. It's not just being filled in by random data or fluff data. We don't have to worry about that because we know this bar is actually being constructed on actual trades and not on time. Do we all understand this? For some of you who are like new to trading, this should be mind blown because the conventional wisdom of people is they always use time-based charts. The market doesn't give a shit about time. It doesn't understand what time is. So why would you ever trade on something that's time-based? Okay? Time is a construction of man, not by laws of nature. All right? Doesn't mean we can't use, daily charts or time-based charts like that. But overall, if you're going to be an intraday trader, you shouldn't even mess with time-based charts. All right. So, reading a quote information. So, this is from Yahoo Finance, the new Yahoo Finance, which arguably sucks in comparison to the old Yahoo Finance. But the point is this is a snapshot of Apple, and we just want to understand how to read this stuff. So the previous close is given here at $145.63. That's what the price closed out the day before. The opening price, if you ever see it, is going to be where price opened today. The bid is the current price someone is willing to pay for the stock. The ask is the current price someone is willing to sell the stock. Okay. I accidentally shoved this together. The range, all right, days range that you see here is the low price for the day to the high price of the day. So the high and the low. All right. So we know that the high was 147 today and the low was 145 today. Okay. 52-week range is the same kind of concept. 52-week range for Apple has been, the low has been 91. The high has been 156 in the last basically year. Remember, there's 52 weeks in a year. All right. Volume is the number of shares traded for the day. Average volume is the average number of shares traded each day over a specified period. So basically, so Yahoo Finance uses 3 months. You always want to make sure, if you believe in volume, that you understand how they calculate this, because sometimes it could be over 6 months. So they take all the volume over the last 6 months and, take the average of it. So just want to make sure like you understand how all these numbers are calculated. And that is a very key thing that I want you guys to always remember. How people serve up data, you need to understand how that data is always calculated. Do not assume that everything is always the same, that there's some kind of standard. Okay? In the finance industry, everyone runs amok. Okay? There's no like golden standard. All right? All right. Next thing we're going to talk about is market makers and level 2. Okay? So we talked about exchanges. We talked about, basically they're the intermediary for buying and selling. Okay. So an MM, or what's known as a market maker, is you could view a market maker as an exchange, but there's much more kind of complicated thing that goes on behind the scenes, especially because now most of it is automated. So a market maker used to be dudes on the floor that would make you a market for whatever you were trying to buy and sell, right? So they were the intermediary guy. So then, because of all the corruption and most of the people on the floor were just fucking assholes, okay? They're terrible people that would take opposite sides of the trade, okay? Making hundreds, if not bajillions of dollars doing this. All right. we gave it to a machine, which is way more efficient and doesn't really try to, I mean, there are predatory ones, but in general, market makers just view them as basically the intermediary. Okay. So you have the New York Stock Exchange, and then there's an algorithm that's a market maker that when you click buy or sell, it's executing that transaction. Okay. But the interesting thing about market makers as a whole is that whether it's a person and a machine or just a machine, when the market is collapsing, right? So let's say I'm selling short the market and it's collapsing. Let's think about it in like a 2008 kind of crisis, okay? So if the market is collapsing like that, then um I don't know what happened here. If the market's collapsing like that, then who's taking the other side of the trade, right? Think about that for a second. Because in order for the market to be collapsing like that, someone has to be on the opposite side. Who's doing that? It's the market maker. Because the market maker's job is not only to the market maker's main job is to buy, provide liquidity, no matter what. Okay. So as the price is going down, they're buying. They have to. Okay, because they have to take the opposite side of everyone's trade. And in an uptrend, it's the same kind of thing. Okay. The other component is what's known as an ECN. And these are generally electronic communication networks that are computerized order placement systems. And it's important to note that anyone can trade through an ECN. So if you use any broker that you use or any terminal you use to execute your trades, to get to the market maker, they have to go through an ECN. Okay. And the ECN is basically the executor. Okay. So the market maker is the filler. The ECN is the executor. So when you click buy, it runs through an ECN that says, Mr. Market Maker, is there anything to buy at this price? Okay. And then the market maker says yes or no, and you get filled or not. Okay. If you put a limit order, it's going to sit. It's going to send the signal go through the ECN and send the signal to the exchange where the market order sits. The limit order will sit. And when price comes to that, the market maker will then be like, yes, this is feasible, and fill the order. Okay. Now, ECNs come in all kinds of speeds, okay? High frequency traders may even sometimes make their own kind of ECN, okay? And that's just to get orders filled, quote unquote, quicker, okay? But most ECNs nowadays are pretty fast and they get filled. But some people may choose to use different ECNs to fill multiple orders across different markets, so that way that they don't get picked up. Because an ECN, you can see the ECN on, a quote board. So you can see the exchange of where it's getting filled. And that's usually what you see on level 2, okay? Is your ECN is saying buy at X price on the bid or the ask. All right. So that's kind of how it works. It's pretty much the ECN sends the signal and the market maker fills the order and executes. And then you get a feedback loop, which is more or less the ECN. Okay. So wholesalers are order flow firms. So many online brokers sell their order flow to wholesalers. These order flow firms then execute orders on behalf of the online brokers. So there is this kind of thing. I wouldn't really worry about it too much. We're not in the business of being a brokerage house, but and we're not, doing any kind of HFT stuff, so we don't really have to worry about that. But there is like a way that they sell order flow, and a broker may get kickbacks, which is illegal as fuck, but it happens all the time. Okay. So, um, this would be an example of kind of seeing the ECNs. So this is kind of what a level 2 book would look like. Um, some of these places don't even exist anymore, like Bear Stearns. But so everything in the book for the ECN will have this kind of like designation. Okay. So it may be like you may see on the book UOBSW. That stands for UBS Securities. And they